Last week, I was reading Wall Street analyst research reports on McDonald's. And I thought the reports all had pretty much a similar theme. McDonald's normally trades at around 22 times forward earnings. It was trading at around 25.5 times forward earnings. So the stock wasn't nosebleed high expensive, but it was more expensive than it normally is. And the analysts were all kind of striking a cautious tone because they saw McDonald's facing some headwinds and they didn't think it was justified for it to be trading at a higher than average multiple. By headwinds, they talked about some things like changes of eating habits due to weight loss drugs. They talked about inflation, which raises labor costs and ingredient costs, something that would have to be passed on to the consumer. And of course, the major issue is that lower income consumers right now in the US seem to be economically squeezed, and since lower income people are a major part of McDonald's clientele, they'll be resistant to paying more for things, and in fact, they're looking for bargains, and if they don't see it, they're likely to start spending less. So you put all those things together, and basically you can make the argument that McDonald's shouldn't be trading at 25.5 times earnings. Now, since they wrote that, beyond expectations that you normally have, is McDonald's shares have been going down over the last several days. Normally, that sort of logic of avoid a stock or reduce your exposure to stock because it's looking a little bit expensive, that kind of thinking actually, although it sounds fundamentally sound, doesn't really usually work so by. What normally happens is we discover that there was a reason it was trading expensive, some unforeseen positive going on in the stock, or just simply the stock had a lot of momentum and just being a little bit expensive wasn't enough to throw it off its higher trajectory. Now, the reason I started off this week by speaking about McDonald's is because I think you can draw an analogy between McDonald's and the greater market. The S&P 500 today is only about 2% from an all-time high. That represents a huge rebound from early April after Trump made his tariff announcements. The S&P 500 is up about 21% from its April lows. So at today's level, valuations, just like McDonald's, they're not nosebleed high, but stocks are looking a little bit expensive. And markets still have some headwinds. You still have Trump as president. He still wants to impose tariffs on many countries. You have other issues of that type. So does it really make sense for stocks to be expensive, or should they be a little bit lower? And in this particular case, could it be like McDonald's, where this feeling that the market should be a little bit lower actually does translate into lower stock prices? The answer to that question is usually that thinking, just like I said on McDonald's, doesn't really work. But if it doesn't work, what will be the forces that send stocks higher? And to me, the most likely thing will be lower interest rates. It's not a given that the Fed will be cutting interest rates later this year, but it's generally expected to happen. Tonight, we have a very important CPI data coming out. I'm speaking to you on Wednesday afternoon in Singapore, Wednesday morning in the US before Wall Street opens for trading. The CPI data will come out. April's data was very encouraging, showing inflation dropping. In fact, Wall Street analysts think that the April number that was so good that the May number, that should be clear, that the number being released right today will be May data, is expected to be not quite as good. But if you look at inflation data around the world, generally it's been coming in better than expected. In our neck of the woods, the last inflation data from Thailand actually showed deflation. I thought that was very interesting. So if we do have a good number today, and instead of year-on-year core CPI ticking up from 2.8% in April to 2.9% in May, if it stays at 2.8% or is even better, I think that this is going to increase expectations for rate cuts from the Fed, and I think it'll be greeted very positively by equity investors. The other piece of the puzzle on interest rates, of course, are longer-term rates like the 10-year yield. The 10-year yield is elevated, more than you would expect, mainly because Treasury investors are very concerned by the size of the U.S. deficits. It's, of course, if you're reading the headlines, you know that Elon Musk just had a big temper tantrum about the size of the deficits that will happen because of that big, beautiful budget. So even if rate cut expectations increase, it won't necessarily translate into lower Treasury yields. Although if the problem with the budget deficits are not too large, which I don't think they are egregiously awful, I think what will most of the impact on the U.S. spending more money than it's taking in taxes by a much wider margin than it should will come out in the currency markets. The U.S. currency, though I hear a lot of people talking about how weak it is, if you look at a longer-term chart, it isn't so weak. Year on year, it's barely changed. Although so far this year, if you just look at the last 6 months, it has been dropping. So the medium-term trend is lower. And the reason I started off by saying it's not, the US dollar is not that weak, that kind of makes me think there's quite a lot of opportunity for it to weaken further. So I expect a weaker dollar, I expect lower Treasury yields, and I expect lower interest rates, and whether that happens sooner or later will have a lot to do with inflation numbers, and I just gave you my view that you're probably going to see inflation dropping in the U.S., which will bolster the expectations for rate cuts.